Jai Hind everyone. Welcome to my YouTube channel, which is Explore Yourselves, Banking and General Knowledge, etc. Today, I will discuss two group discussion topics related to the internal promotion examination for banks. Welcome to part 13 of my Path Through the Corner Office 2025 to 2026 series, where we break down real bank promotion exam questions and give you clear practical sample answers about group discussions to help you climb the career ladder faster. Group discussions topic. First, impact of global financial crisis on Indian banks. Second, contactless banking, future of customer interactions. Impact of global financial crisis on Indian banks. Global financial crises have a significant ripple effect on banking systems worldwide, and Indian banks are no exception. Events such as the 2008 global financial crisis, the Eurozone debt crisis, and pandemic induced economic shocks illustrate how interconnected global financial markets can influence domestic banking. Indian banks, both public and private, face multiple challenges during such crises, including liquidity shortages, credit risks, fluctuating foreign investments, and policy uncertainties. At the same time, crises also present properties for strengthening risk management, improving regulatory frameworks, and adopting innovative practices. Understanding the impact of global financial crisis on Indian banks requires a balanced analysis of both the risks and potential benefits. Positive aspects, pros, and arguments in favor of bank, banks adapting to global crisis. First, strengthening risk management practices. Global financial crisis exposed vulnerabilities in banks' portfolios, lending practices, and operational resilience. In response, Indian banks often enhance risk management frameworks, introduce more stringent credit assessment procedures, and adopt advanced monitoring tools. Improved risk management not only mitigates the impact of crisis but also builds long-term resilience. Second, policy interventions and support mechanisms. During global crisis, the Reserve Bank of India and government often introduce measures such as liquidity injections, credit guarantee schemes, moratorium on loans, and capital adequacy support. These interventions help banks maintain stability, prevent systemic shocks, and continue lending to productive sectors. Third, adoption of innovative practices. Crisis push banks to innovate and improve efficiency. For example, during periods of market volatility, banks adopt digital banking, fintech collaborations, and alternative financing solutions to maintain customer engagement, streamline operations, and reduce costs. Fourth, opportunity to attract foreign investment in the long term. While crises initially deter foreign capital inflows, a stable and well regulated banking system can attract foreign investors seeking secure opportunities. Indian banks with strong governance and transparency may benefit from portfolio investments, foreign direct investment, and capital market participation. Fifth, awareness of global interconnectedness. Global crises teach Indian banks the importance of diversification, exposure management, and international market awareness. By learning from past crises, banks can better hedge foreign exchange risk, manage interest rate fluctuations, and mitigate contagion from electric external shocks. Negative aspects, cons, and arguments against or challenges. First, rise in non-performing assets. Economic slowdowns triggered by global crisis often affect borrowers' repayment capacity, leading to higher NPAs. MSMEs, exporters, and sectors reliant on global demand are particularly vulnerable. Rising NPAs increase provisioning requirements and reduce profitability for banks. Second, liquidity stress. Global financial crisis can create liquidity crunches due to reduced capital flows, declining deposits, or withdrawal of foreign funds. Indian banks may face challenges in meeting short term obligations, disbursing loans, or managing operational costs. Third, volatility in foreign investments. Global crises often result in capital flight, currency depreciation, and stock market fluctuations. Banks exposed to foreign debt, equity investments, or external commercial borrowings may suffer losses, impacting balance sheets and investor confidence. Fourth, policy and regulatory challenges. During crisis, changing regulations and interventions can create uncertainty. Banks must quickly adapt to altered capital adequacy norms, lending requirements, or moratorium guidelines, which may increase compliance costs and operational complexity. Fifth, negative impact on profitability and growth. Global crises often reduce credit demand, depress interest income, and slow down business expansion. Banks may experience lower revenue growth, reduced margins, and delayed project financing, affecting overall profitability. Sixth, operational risks. Crises often require rapid shifts to remote operations and digital banking or emergency measures. Inadequate preparedness can result in operational inefficiencies, cybersecurity risks, and service disruptions for customers. Balanced comparison. Global financial crisis present both threats and opportunities for Indian banks. On the one hand, they pose serious challenges such as rising NPAs, liquidity stress, currency and investment volatility, and regulatory complexities. Banks exposed to high-risk sectors or global markets may experience significant losses and profitability may be adversely affected. On the other hand, crises encourage banks to strengthen risk management practices, adopt technology driven solutions, improve corporate governance, and diversify portfolios. Policy interventions by the RBI and the government cushion banks from immediate shocks while promoting long term stability. Lessons learned from crisis enhance preparedness, improve operational resilience, and create opportunities for strategic growth, particularly in foreign investment, cross border collaborations, and fintech adoption. A balanced approach requires Indian banks to manage the trade-off between the short-term challenges and long-term opportunities. Prudent credit appraisal, diversification of assets, effective liquidity management, and adoption of digital tools are crucial to navigating global financial turbulence. Simultaneously, banks must leverage crises as opportunities to modernize operations, adopt practices, global best practices, and strengthen stakeholder confidence. Arguments for Indian banks benefiting from global financial crisis. Strengthens risk management and credit assessment frameworks, promotes operational innovation and digital banking adoption, encourages policy reforms and regulatory improvements, provides opportunities to attract long-term foreign investment, enhances awareness of global market dynamics and interconnected risks, encourages diversification of portfolios and exposure management. Arguments against or challenges faced by global crisis. Increase in NPAs and credit losses, liquidity crunches affecting loan disbursement and operations, volatility in foreign investments and currency fluctuations, regulatory uncertainty and compliance challenges, reduced profitability and revenue growth and business expansion, operational disruptions and technology related risks. Conclusion. Global financial crisis significantly impact Indian banks, exposing vulnerabilities in credit portfolios, liquidity management, and operational efficiency. Rising NPAs, currency volatility, reduced foreign investment, and regulatory challenges pose immediate challenges to sustainability and profitability. However, these crises also act as catalysts for structural improvements, stronger risk management, and adoption of digital banking and policy evolution. A balanced perspective reveals that the long-term opportunities outweigh short-term setbacks if banks adopt prudent strategies. Strengthening credit appraisal processes, diversifying assets, managing liquidity, and leveraging technology can help banks withstand external shocks. Policy support from the RBI and government ensures that systemic risks are minimized, enabling continued credit flow and economic resilience. In essence, global financial crises are both a threat and an opportunity for Indian banks. While the intermediate impact may challenge stability and profitability, these events compel banks to modernize operations, embrace innovation, and strengthen governance. Banks that learn from past crises adopt proactive risk management, and maintain operational flexibility are better positioned to navigate future cultural shocks, ensuring sustainable growth and contributing to the resilience of India's financial system. Contactless banking, future of customer interactions. Contactless banking represents a paradigm shift in how customers interact with financial institutions. Powered by technology such as near field communication, QR codes, mobile wallets, biometric authentication, and tap and go cards, contactless banking enables transactions without physical touch points. The COVID 19 pandemic accelerated the adoption of contactless methods as customers sought safer, faster, and more convenient banking experiences. In addition to safety, contactless banking promises speed, efficiency, and digital transformation. However, it also presents challenges in terms of infrastructure, cybersecurity, and customer adaptation. A holistic evaluation of contactless banking requires weighing in its benefits against the limitations of assessing its future potential for both banks and customers. Positive aspects, pros, and arguments in favor of contactless banking. First, speed and efficiency of transactions. Contactless banking dramatically reduces transaction time. Customers can complete payments, transfers, or balance inquiries in seconds using mobile apps, cards, or digital wallets. This convenience is particularly beneficial in high traffic environments such as retail outlets, public transport, and e commerce platforms. For banks, faster transactions mean improved customer satisfaction and reduced in branch congestion. Second, safety and hygiene benefits. The ability to conduct banking transactions without touching physical surfaces reduces the risk of contamination, fraud at ATMs, and card skimming. Contactless payments offer a hygienic and secure alternative to cash, especially during health crises like the COVID 19 pandemic. Third, increased adoption of digital banking. Contactless methods encourage customers to embrace digital banking and online financial tools. This trend supports financial inclusion by connecting previously underserved populations with banking services, enabling access to payments, savings, loans, and insurance through digital platforms. Convenience and customer satisfaction. Contactless banking allows 24/7 access, seamless payments, and minimal dependency on bank branches. It supports mobility, reduces waiting times, and empowers customers to manage finances at their convenience. Enhanced customer experience strengthens loyalty and brand perception for banks. Fifth, potential for innovation and cross-selling. Digital and contactless platforms enable banks to integrate value-added services such as instant credit, loyalty rewards, personalized offers, and financial management tools. This integration creates opportunities for banks to increase engagement and revenue streams. Sixth, operational efficiency for banks. Reduced footfall in branches and lower cash handling requirements decrease operational costs. Branch staff can focus on advisory services and complex banking needs rather than routine transactions, improving efficiency and resource allocation. Negative aspects or cons, arguments against or challenges. First, infrastructure and technology requirements. Implementing contactless banking requires investment in NFC enabled POS machines, secure mobile platforms, upgraded ATMs, and robust network infrastructure. Small banks and regional branches may face financial constraints in adopting these technologies across all locations. Second, cybersecurity risks. Digital transactions are vulnerable to hacking, phishing, malware attacks, and unauthorized access. While encryption and tokenization reduce risk, cybersecurity remains a major challenge. Banks must continuously invest in security systems and educate customers on safe usage. Third, limited adoption among certain demographics. Older populations, low income groups, or people in rural areas may face difficulties adapting to contactless methods due to lack of digital literacy, smartphones, or internet connectivity. This can create a divide between digitally savvy customers and others. Fourth, dependency on technology. Service disruptions due to power outages, network failures, or software glitches can impact customer experience. Unlike cash or traditional banking, contactless banking is entirely dependent on digital infrastructure. Fifth, risk of over-reliance on digital platforms. Overemphasis on contactless methods may marginalize customers preferring traditional banking, leading to dissatisfaction. Banks need to balance digital adoption with availability of human support and bank branch services. Sixth, transaction limits and regulatory restrictions. Contactless payments often have limits per transaction to mitigate risk. These caps can restrict utility for high value transactions, requiring customers to resort to conventional methods. Balanced comparison. Contactless banking offers compelling advantages in speed, convenience, hygiene, and operational efficiency. Customers benefit from faster transactions, 24/7 access, and digital management of finances. Banks gain through improved efficiency, reduced branch congestion, and opportunities for cross-selling and personalized services. Safety and hygiene benefits are particularly critical in health-sensitive contexts, increasing adoption rates. However, challenges remain. Cybersecurity threats, infrastructure costs, digital literacy gaps, and over-reliance on technology can hinder the adoption and sustainability of contactless banking. High risk exposure in case of system failures or breaches, along with limitations for certain demographics, underscore the need for balanced implementation. Banks must invest in secure infrastructure, customer education, and inclusive digital solutions while retaining accessible branch services for those unable or unwilling to adopt contactless methods. A balanced strategy involves integrating contactless banking with traditional challenge, ensuring robust cybersecurity measures, offering educational programs for customers, and providing alternatives for underserved populations. Regulatory compliance and adherence to transaction limits are also critical to ensure safety and trust. Arguments for contactless banking speeds up transactions and reduces queues, promotes hygiene and reduces physical cash handling, encourages digital adoption and financial inclusion, enhances customer convenience and satisfaction, reduces operational costs for banks, enables innovation in cross selling and personalized services, supports seamless integration with fintech solutions. Arguments against and challenges. High infrastructure and technology investment required, vulnerable to cybersecurity threats and digital fraud, limited adoption among elderly or rural populations, dependent on uninterrupted digital networks, risk of marginalizing non-digital customers, transaction limits restrict high-value payments, requires continuous education for support for users. Conclusion: contactless banking is set to become the future of customer interactions, transforming how individuals and businesses manage financial transactions. Its advantages in speed, safety, convenience, and operational efficiency, make it an attractive proposition for both banks and customers. By facilitating digital adoption, contactless banking enhances financial inclusion, promotes hygiene, and offers opportunities for innovation and personalized banking services. However, its success depends on addressing challenges such as cybersecurity, infrastructure costs, and digital literacy gaps. A balanced approach requires banks to invest in secure, resilient technology, educate customers on safe usage, and maintain alternative channels for populations less comfortable with digital tools. By combining contactless solutions with inclusive practices and strong regulatory adherence, banks can ensure that the shift towards digital interactions benefits all stakeholders. In conclusion, contactless banking is not just a temporary trend, but a strategic evolution in customer service. When implemented thoughtfully, it enhances customer satisfaction, strengthens operational efficiency, and positions banks for long-term growth in a digitally connected world. The future of banking lies in providing seamless, secure, and convenient contactless experiences without leaving behind those who rely on traditional channels. Thank you very much for your patience. Please like and share this video and subscribe to my YouTube channel.